Hello and welcome to our Age Well webinar today. My name is Alison Schneider, and I am the Education and Training Manager at Age Well, Canada's Aging and Technology Network. In today's Age Well session, the Angel Investor Playbook, From Pitch to Partnership with Steadiwear, we will explore and offer insights into understanding the role and importance of angel investors in the startup ecosystem. We're excited to have Emile Maamary, the co-founder and CMO of Steadiwear, as our main presenter for the session today. Mike Krostowski, our Director of Business Development and Partnership at AgeWell, is here as well, and he'll add a short overview of capital investment in general. Mike and Emile will both be here to answer any questions you may have throughout the session today. So Mike will provide a 10-minute intro into capital investment, and then Emile plans to speak for about 40 minutes, and we will have a Q&A session to follow. Please post any questions or comments for the Q&A in the chat or in the Q&A box at any time. You may also raise your hand to ask questions verbally if you like. This webinar is being recorded and will be available for replay on the AgeWell members intranet and the AgeWell YouTube page. So without further ado, I will turn things over to Mike to get us started. Mike?
Thanks, Allison. Thanks for having me here, and welcome everyone. So I'm just going to share some slides, and as Allison mentioned, I just have quite a brief presentation on capital investment. So we'll take you through a little bit of that. I think most of what you'll learn on this topic, and especially when it comes to angel investing, you'll hear from Emile, but happy to give a little bit of an overview and some tips and things that I've seen through the AgeWell network and our startups. So without further ado, we'll get right into it. When it comes to looking at investment at different stages for a startup, usually startups will start out with seed stage investment, and this can be just money you as founders may put into the startup yourselves. It might come from friends and family that believe in what you're doing, are looking to support you, and of course, angel investors, and you'll hear a lot more about that. And at this stage of your company, you're really kind of just beginning. You've established something, you may have had an idea that you've implemented, developed a prototype, and you really want to kind of validate that business idea. You may already have some sales, but oftentimes you don't. You've kind of have an initial idea of your go-to-market strategy and your business model, and you need some capital to come in to help to kind of finalize that prototype and start to grow your business. Going beyond that, at the next stage, when you're maybe looking for more significant investment, you might turn to VCs or venture capital firms. And here they will often provide most of the funding at what's called the Series A stage. And in this case, you're really kind of scaling and growing the company. The product is out there, and you want to maybe either grow it and expand into other areas, potentially developing new products, maybe kind of like a platform that your products fit into. And really, it's all about growing the company a little bit more and more rapidly, getting more interest from the market. And usually at this stage, your team is growing as well, and you will need more money than you typically find at seed stage. And this is why you'll usually go to venture capital firms as opposed to maybe individual angel investors. And you'll be raising kind of potentially millions of dollars. And then beyond that, there's Series B, C, and so on, and other stages to really kind of scale up and grow your business more rapidly. Here, you'll often start seeing the challenges of how to grow as a company, how to deal with much larger workforces and markets in multiple parts of the world. And so here, a lot more money gets raised. There's a lot, your company and your team will have changed usually dramatically from the seed stage. And at this point, you'll still be working maybe with VCs and in some cases kind of bigger institutional investors to help bring that additional capital in. So throughout that, there's some common threads that I think are true in terms of the advice you should take and keep in mind as your company is growing. But certainly they're very different in terms of the maturity of your company, your team, and who's involved. And, as an example, maybe you're still running the company at the seed stage, but by the time you get to that growth stage, you may have a different role. You may be a CTO, you may, be a CSO, kind of just looking mainly at the science or technology or the R&D. Maybe someone else has come in into the company to kind of play the role of CEO at that point. A lot of those things can change, but you still play oftentimes an important role in justifying those levels of investment. So I don't want to take up too much time talking about angel investors per se, because I know Emile will talk about that, but just briefly to differentiate them from VCs. These are high net worth individuals. They are often bringing in for you not just the money and the investment, but also valuable mentorship and oftentimes connections for you as well. And that is very important for startups at that seed stage. And I found that oftentimes when it comes to pitching to these investors, the personal side of it, how they resonate with the founder, their passion, their own story, this can be very critical. Maybe they've had personal experiences or experiences in their family that really resonate with what you're doing, the problem you're solving, and that can oftentimes motivate their investment. They'll still care about all the other things you'll hear about today, but I have found that that personal piece to it can be quite important when you're dealing with these individual investors. With venture capital firms, you're looking at usually much larger investments, and oftentimes maybe taking even more equity in the company they're investing in. They certainly want to see these high potential startups that they would put money into. There's a lot more due diligence and a lot more you have to have in place to really kind of convince them that your company is worth investing in. And it's not uncommon for multiple VC firms to be involved in an investment round, although oftentimes there will be one kind of lead investor there. So you may need to kind of win over one and then kind of use that in your round to get more investment as well. And just briefly, I want to touch on corporate investors. So these might be larger companies that will sometimes invest in startups. There's a lot of reasons they may do this. In the age tech space, we've seen this especially in senior living, where some of the more established senior living players have invested in startups because they've obviously believed in the innovation, but they also feel that they can benefit in terms of their operations, their business, or get a competitive advantage by having a closer relationship with that startup. So it's a little bit different there, but it certainly serves you to then have a good relationship and good understanding of that space if there is investment opportunity from that sector. Just quickly, some general tips, and obviously these slides will be shared. It's to kind of really know what you'll have in your data room for due diligence with investors early on, understanding the kinds of things you should be documenting and tracking, and later have that easily accessible rather than scrambling when you do engage with investors. Having a good shareholder agreement, especially early on, you want to have all of that clean and any co-founder issues addressed. Good IP strategy, way too much to talk about than I could fit in here, but obviously I will say for AgeWell, we have different partners that can help with that. Also understanding your regulatory pathway, if that's applicable, you should really have that in mind early on, so that you're not caught at the time of investment with figuring out what to do or realizing that maybe you haven't adequately understood what kind of not just regulatory approvals you might need, but what you need to have in place in terms of a quality management system to do that. So things you should definitely look at early on. And then just an overall point I would make at all stages of investment, feel especially when you're coming to someone new, it's important for you to demonstrate how you've delivered in the past on investment or funding so that they feel more comfortable with the idea of you delivering a return on their investment. Quick pitfalls and pitches, know your numbers really well, know your business model really well, because people get tripped up on that in Q&A with investors. Get feedback from different groups, different types of people on your pitch, not just friendly kind of people. Difference between passion and arrogance. You want to show passion in your pitch, but when you're questioned by investors, try not to be too defensive, understand, and even sometimes acknowledge potential risks and how you'll address them before you're asked about them. Balancing focus and vision. Investors want to see that you do know what you want to achieve, what your priorities are, and that you'll be able to focus on them, while at the same time seeing how you're going to grow this company and how maybe this initial prototype or product that you're pitching isn't the only thing that you have in mind in your pipeline. So there's a balance to be found there. One of the last things I want to talk about is just the importance of networking. So work with different opportunities to connect with investors at events through those mentors or advisors you'll have. Getting a board of advisors will be key, especially when you're beyond the seed stage, and use that to connect with investors and then stay connected with them. Some may not be ready to invest now, but will be interested to have updates on what you're doing. When you do that, do it with the right cadence, not too often, and also make those updates interesting. And that can sometimes help create opportunities for you later on. So, I'm almost at time. So just to conclude here, with AgeWell, we've seen startups reach success with investors in different stages, and oftentimes they're open with sharing their lessons. I know you'll hear from Emile today, and certainly there are others that would be open to sharing with entrepreneurs and early stage startups. And when you do fundraise, what you're going to look for or try to achieve, it's going to depend on your readiness and capacity. But look for ways to engage early and keep people informed. And then finally, just saying to always keep in mind as you're looking at investment and terms, yes, you started this, you grew it, you see a lot of value. Giving up equity can be hard. Know that you're not going to be able to achieve all the things you want to achieve alone. And securing that investment, oftentimes, especially if it's smart money that comes with mentorship, advice, connections, experience, it's going to pay off and it'll be worth it. So I'm going to stop there, I think, right at 10 minutes.
Thanks, Mike. We'll move things over to Emile now in his presentation on the Angel Investing Playbook. And note that if you do have any questions, feel free to ask those as we go through our presentations for Mike or Emile, and we'll also have time at the end to address any lingering questions you might have. Okay, take it away.
Thanks for the intro, Alison. Thanks for having me again. Can everybody see my screen okay? All right, perfect. My name is Emile Maamary. I'm the co-founder and CMO at Steadiwear, where we are pioneering novel stabilization technologies. Our first product has been the device designed to reduce hand tremors, which some of you may have seen. We target essential tremor and Parkinson's disease, and I'll elaborate more on the product throughout the presentation. What we're going to do today is we're going to go through the highlight some points about angel investing, and then we're going to talk a little bit about due diligence, talk a little bit about creating an impactful pitch, mastering negotiations, what pitfalls to avoid, and then I'm going to run you through our deck, and you guys are going to see what could be right and what could be wrong, and we're going to talk about it a little bit further. I'm expecting a lot of questions. I'm happy to be interrupted at any point. If you prefer to use the chat, I am using a full screen on the slide deck. So Alison, just interrupt me and ask the question if one does come up. And I'm without further ado, I'm going to get started here. So, first slide, understanding angel investing. In Canada, there are really definitions for high net worth individuals that are providing capital for startups. In the case of angel investors, I think they have to have an income of at least $200,000 or assets over $1 million. And those are financial assets, or net assets over $5 million. So, think real estate, other types of assets that could also be of value. Institutional investors are a little bit different. We'll talk a little bit about that later. Some of the differences between angel investors and VCs, which you might have heard of. Angel investors, they're using their own money. They're investing a smaller amount of money. They're providing mentorship, as Michael alluded to. VCs, they've taken money from other people. They're making bigger investments. They're usually making them at later stages, and they also get their hands dirty more frequently. They come up with company strategies. They focus on achieving high returns, and they like exits, like IPOs and acquisitions. To be honest, angels like those too. Angels like to see them in a much shorter span than VCs. VCs are okay with 10-year timelines. Angels like to see things like 5 to 7 years that they're more excited about. Again, that's because they're investing their own money, right? Angel investors, they play a crucial role in early stage investments. They really they take the risk when the banks and the VCs are not willing to take the risks, right? They provide the funding, they help the startups really develop their product, initiate their first team members. They celebrate all those early milestones with you, right? Unlike the bigger investors, they're motivated not just by financial returns, but really with a genuine interest in the founder's vision, their industry, their product. So keep that in mind when you're presenting to them, right? For example, like we have some investors involved with Steadiwear that they care a lot about hand tremors. Some of them have tremors in their families, and you could see just how immersed they are. They're really always willing to go the extra mile, and not just with funding. They help us find distributors. They help us find manufacturing partners. So it's really important to keep that communication flowing and reach out to them and have a good conversation whenever you can. So just to elaborate on that a little bit, angel investors, as we mentioned, they provide funding, mentoring, networking. And one thing I should really mention is that, by providing this early financial boost, angels, they enable startups to gain that early traction. It's so important. It helps them reach important milestones and position themselves for future rounds. The mentoring that they involve themselves in the startup with can sometimes not be as relevant, but it's really about how much you involve them in the company. So if you're having monthly calls, their guidance could be relevant to you. Maybe it's outdated, but it still could be beneficial. If you're meeting with them on an annual basis, I think you'll know your business better than the angel investor themselves. In terms of networking, one thing you'll see later on in the presentation is that we highlight the importance of really staying in touch with these angel investors. And there are multiple ways to do that. You can either go to networking events, you can attend conferences, or most importantly, you can keep them updated through LinkedIn or some email marketing campaigns that you could have be sent out either a monthly, quarterly, or annual basis. We'll discuss the pros and cons of each along the way. But let's talk a little bit more about their angel flexibilities, risk appetites. What makes them special. Unlike the traditional lenders, and VCs, angels, they're using their own money, right? So they often invest in companies that have they have some understanding behind, and they're also a little bit more flexible in the sense that they're willing to understand the potential. Maybe you won't have a clear idea of how much potential, but as long as they can see the understanding of where this can go, they're more willing to take a best bet on you, even if it means that you don't have the exact business model yet, or you may have limited traction. They're still willing to provide you with that crucial initial support that many companies need at the early stage. Angels, they typically are more open to investing on founder-friendly terms. You might have heard terms like the SAFE agreement, which is a much better agreement for both the angels and the entrepreneurs. Honestly, it's better for the entrepreneurs in the beginning. Some investors are shying away from it because there's no risk on the back of the entrepreneur if things fall apart. We'll talk more about these terms later on. And when you talk about the risk appetite, I would classify the angel investor as a high risk appetite. I think that they're willing to, take the potential of a high loss in exchange for joining the company and the potential of having substantial returns. They're in for the ride, right? Their tolerance for risk is higher, and as a result, they're willing to invest in these innovative and disruptive ideas that might change the world. So let's talk about some examples. Google, some of you may have heard of Andy Bechtolsheim. Andy Bechtolsheim, he was the co-founder of Sun Microsystems, and he was actually one of Google's earliest angel investors. 1998, he gave Larry Page and Sergey Brin a $100,000 check. And that was back in 1998. You can only imagine how much money it's worth today. He took a risk on them. His backing was instrumental. It validated Google's potential, and it helped the founders attract other funding. Peter Thiel, for example, he invested in Facebook really, really early on, 2004. For some of you who don't know who Peter Thiel is, he co-founded PayPal, and Peter Thiel put $500,000 in 2004 in Facebook, so he owns 10% of the company. I don't know how much he owns right now, but that's how much he owned when he invested in the company. So Peter Thiel, again, he opened the doors for Facebook. He helped them grow rapidly, gave them a lot of ideas, and really enhanced their credibility early on, and that allowed them to build that transformational company. In the case of Steadiwear, we had some early investors, angel investors. One of our early angel investors, he has a couple of other startups in his portfolio, but I wouldn't classify him as an institutional investor. However, his investment became the lead investment in our first round, and that gave us a lot of credibility because we were able to build the term sheet, and we were able to shop that term sheet with other investors saying, hey, we already have the money in the bank, and this angel investor trusts us enough, and he supported us early on. This angel investor was based in the UK and prefers to remain anonymous, but he has a really pressing relationship with hand tremors, and that's why he joined our mission. So, some of the strategies for success. You see, you really need to understand what the investor interests are, what the market potential is, the team, and the unique value prop. For example, I'll compare Steadiwear to some of its competitors. There's a company out there called GyroGear. They have built a gyroscopic a glove that attaches to a gyroscope, and it spins at 20,000 RPM, also to stabilize your hand tremors. And what they do in this case is they do the exact same thing as us. They raised $5 million earlier on, and they raised that through a combination of grants from the EU, where they're based, and also some investors. They really became comparable to Steadiwear. So when investors were looking at Steadiwear, they were saying, oh, okay, let's look at the market potential of GyroGear. They raised a little bit of money earlier on. Let's compare their teams. Let's compare their value prop. And most importantly, they then started comparing the storylines. You know, why did we start this company? Why did we start it now? Those were really important things to highlight. And once you've gotten over that hump, the next point of a key strategy that will lead to your success would be strong business models and revenue strategies. Again, we were under the lens of scrutiny, and they were comparing us to companies like GyroGear. They were saying, oh, you know, GyroGear, they're going after a different model. Like, they were going after a reimbursement pathway in the US. They started in the EU. Why didn't you guys start in the EU? I noticed that they have a class 2 device. You guys have a class 1 medical device. Many questions were being raised, and you really have to be able to back them up. And you know, with Steadiwear, we wanted to go through a direct-to-consumer approach. We were building an e-commerce brand, and what we realized was that business model, it was good for the first, let's say, 500 beta testers or 500 customers, but it wasn't good for scaling, right? So we had to change our business model and leverage other companies. Like in this case, it was Liftwear. Liftwear, maybe you've seen that company. It makes a spoon. It's a spoon that stops your tremors. And what they do is they offer a B2C approach where you can buy the product online, but they also have a demonstration-friendly model where physicians or patients, in this case, sorry, can try the device before they buy it. They would go to an assistive technology clinic, and in some cases, they would borrow the device, try it. If they like it, they would return the device to the lending clinic and buy it online. So really, what I'm trying to get to is that you really need to use a proven strategy. you need to build a compelling story, and you need to have comparables from other companies in your space to get the investor's mind jogging. Because if you're building something that's really, out of out of the box, out of the traditional continuum of care, investors won't know in which box to put you. They won't know how to compare you to other companies, and that can be a big source of friction, and as a result, lead to a no early on. So let's talk a little bit more about creating your impactful pitch. What I would suggest is to not deviate away from the structure that you typically see. The Guy Kawasaki 10 points, 10 slides, sorry. You want to follow the 10-20-30 rule. You want to stick to the basics. And the reason for that is because investors, they're sometimes looking at 30 slides a day. So you really want to make sure that you're not going too far away from the traditional slide deck. And later in the presentation, we're going to go through a slide deck as an example. We're going to use Steadiwears to see, what key elements I might be missing, and understand the structure a little bit better. Something that's really important to also do is to really tailor the pitch to investors' interests. So, for example, if you're pitching an investor in Japan, maybe you should highlight the market size of your product, your total accessible market, the potential that you might have in that market. Maybe you should talk about what it would be like to launch the product there. Are there any regulatory requirements, any hindrances? Which translation partner are you going to be using there? Um, the level of detail really dives into how many meetings you're going to have. But I would start with, for example, highlighting the market size, discussing, what the purchasing power could be like in that market. And, if for any chance, if by any chance the exact distributor that you'd be looking for in that local market, it wouldn't harm to mention their name throughout the presentation. Maybe the investor knows them and could potentially pitch your business to them. People talk, right? Especially when you're pitching outside of your comfort zone or outside of your geographic location. The networks that investors have can really spruce up your pitch and help you expand. So let's dive a little bit deeper here into the approach of funding. What you really need to start with is the objective, defining what the financing will achieve. So, for example, hey, this pitch I'm doing is going to help me finance a round of $1 million. It's going to spend 50% on marketing and sales, which will help us hire a sales agent, expand our sales teams, test out a couple of different online strategies for marketing. And we're also going to spend 25% on product development and 25% on regulatory, IP, and clinical validation. So that gives the investors an idea of how you're going to use their money. Investors, they don't like to see too much money being spent on R&D because in their mind, they're thinking, hey, if you're coming to me and saying you have the objective of raising money, then you're probably doing that to really really commercialize a product that you might already have. If you're still on the napkin, if you're still at the napkin stage and there are a lot of product development costs, they might rule out your idea. I don't mean to scare you or mention that that's impossible. There are many companies that were able to raise money and spend a lot of money on product development, specifically in biotech, for example. But investors in this economic environment are a little bit more hesitant to do that. They'll kind of say, hey, why don't you cut the corners and try to take the product to market, validate your market, identify whether or not this market really is worth going after before spending a lot more on R&D. So just a point there. Specific goals that you might have to mention are, of course, as we mentioned, hiring, developing a new technology, talking about your product development cycle. You might want to mention what your cycle looks like right now, if you have an established one, or if you are, in talks with a manufacturer. You don't have to mention their name, but really try to show them an outline of the supply chain. Try to give them an idea of where you're going to go with this money. The more you elaborate on these key points, the more informed you look and the more de-risked your investment becomes. So I know that Michael touched a little bit on this, but we're going to go over this one more time. There are different streams of funding. I'm not going to dive too deep into them. We're going to highlight them on a high level. So in this case, we're talking mainly about angel investment. And as we mentioned, mentorship, early stage funding are the benefits. The cons is they take a lot more equity and they try to influence your decisions early on. VC, more capital, more expertise. They want even more control, and they really put a lot of pressure on returns. They care about your year over year returns. They want to see 30, 50, or 100% rate of return on an annual basis. And I'm talking about revenue. Crowdfunding, this is a really slow way of raising money, but it gives you the validation that you need so you can run a pre-order campaign. No equities associated with it, but again, it's really a lengthy timeline associated with this stream. It's not for all businesses. You know, if you are building something that's really lab focused, then it might be hard for the general population to understand what you're doing until it comes to fruition. So, you know, take this with a grain of salt. Bank loans are they're valuable. In Canada, they're a little bit harder to achieve. I would say that the benefits, of course, are less equity dilution, or if any. The problem is that you're going to have to put some collateral up against it, and the interest rates are really high right now. The last two are the most common. You know, you bootstrap to maintain full control and lower debt, but of course there are limited resources associated with that and personal risks. And grants, you know, like AgeWell has some of these grants programs that Steadiwear has leveraged. They are very valuable. They can help you build out a product in the beginning, or at least build out the ideation process, and they're non-dilutive. The problem here is, again, time and lots of competition. So I haven't heard anybody interrupt me yet with any questions, so I'm going to keep pushing through. We still have a lot of content to cover, but don't hesitate to stop me at any point and ask any questions you may have. In terms of what investors care about, you know, really it differentiates based on the investors. So I would say for angels, they care about early exits, they care about risk assessment, and they care about alignment of interests. For VCs, they care about ROI, they care about risk mitigation, they care about growth at the fastest pace possible, and they also care about alignment with investors, but it's more of a control of alignment. So they really want to make sure that they understand what you're doing. They might want to micromanage you, and it's your job to really balance that out. It really is a balancing act. So you're raising money. You think you have a good idea of what you want to have ready for the investors, and really there's a checklist that you should be going over. Have you elaborated on your financials? Have you built projections? Have you gone over your incorporation documentation? Is there a patent that you can show that you maybe have filed for? What type of market analysis have you done? And what type of team have you built? Really, what you want to do is you want to have all these documents ready. Be as transparent and honest as you can. Because what's going to happen is investors are going to ask questions. And it's really better if you are able to answer these questions in a short and concise fashion, and then refer to the documentation. I'll give you a couple of tips and tricks that we've seen over the years. What we do is we try to build an organized folder in the cloud. Some programs, we prefer one called Box. It allows users to track how many views each file has had, and that also shows you where the IP address came from, so you can identify which investor from which country saw the file, and next time you speak with them, you might elaborate, hey, I noticed that you looked at our executive summary. Do you have any questions about that, for example? Executive summary, it's a really good one to have. Investors, not all of them have the capacity, and specifically in the case of angels, they're really not able to look at that much deal flow and then look at it in that much detail. So it's really important to have a key slide deck, an important executive summary, and not to overflow them with too much information. I'm not talking about handling every single non-disclosure agreement you've ever signed with a team member in this folder. I'm talking about having the key important things like, your projections in there, your slide deck, your executive summary, any IP that might be valuable, any potential distribution deals that might be put on paper. Things that are gonna be concise, clear, and really help the investors understand what stage your company is at.
We have
What's
one
important?
question, if I
Yeah,
can
for sure.
interject. Okay. So Farnaz is asking, how is it possible to know more about what investors care about? Sometimes our
Yeah.
business is aligned, but we still have difficulty to find the golden keywords to communicate with them.
Yeah, that's a great question. Thank you for asking it. So I would always start by going over to their website and really looking at their portfolio companies. I'm going to mention this again at some point later in the slides, but what I really like doing is going over there, looking at the portfolio companies, even reaching out to the founders. And when you reach out to the founders of those portfolio companies on LinkedIn, uh, I would say 3 out of 4 times they would respond saying, "Yeah, I'm happy to chat." And even then, they might even be willing to do it within 48 hours if you're under deep due diligence and you don't have much time to make a response. Um, I've done it before applying to dilutive programs, and it's happened that the other founders were very, very informed, and they helped me better understand my potential investor. They helped me better understand what they were looking for, and it helped me lead to a better and short, concise discussion with this investor as an introductory meeting. I also took notes of what specific financial templates, for example, they were looking for, or what markets they specifically care about, and built my market analysis around that. So I hope that answers your question. One other thing you can also do is try to reach out to they don't have to be potential founders, or sorry, portfolio founders. They could be companies or people that used to work at that company in the past, and those people are even more likely to give you information that might not be available, or the founders of the current portfolio companies don't want to disclose, if you catch my drift. Um, I'll give you an idea of like more preparing due diligence documentation. So for example, what I do is, yeah, I start with the LinkedIn outreach. I see if the investors are, if they're at the beginning of their fund, at the end of their fund. That's a critical point. In the case of angels, it's less likely of a problem. Angels, they tend to have quarterly meetings. So as long as you fit into one of those quarterly meetings, you'll be able to pitch to them. And what I try to do is I even try to reach out to an individual angel in that angel network and try to touch base with them and see, hey, what's it like to pitch this network? For example, we are pitching Golden Triangle Angel Network out in Waterloo, right? So what I'll do is I'll go on LinkedIn and I'll type in Golden Triangle Angel Network, and I'll see which people are involved there. I wouldn't look at their steering committee, but I'd try to find an individual investor who's involved in that network. I'd reach out to them and transparently saying, "Hey, I'm interested in pitching GTAN. I'd love to have a 15-minute coffee chat with you. Can be virtual. I'd love to learn more about what really what boxes need to be checked to better understand and better pitch GTAN, and go through the screening process with them together and come out with a fruitful outcome." So I hope that answers your question, and I'm going to continue to the next slide. So some of the pitfalls, things that I've noticed. Sometimes you walk into the room and you say, "This is a multi-billion-dollar idea." And you say, "This is the first device of this," or "This is the first idea of this sort. So there's no competition." So that means that there are no comparables. All these things might elude a lot of interest, but they also create a lot of fear. Why? If you can't back that market sizing response that you gave, you're going to look silly. If you can't identify at least one competitor, then you're going to look ill-informed. And if you can't show them one comparable evaluation, then investors aren't going to know in which box to put you in. They're not going to know how to evaluate your company. These are tough questions that you have to ask yourself. And if you don't identify them correctly, very early on, investors are going to be able to smell that something is not going right. And they're going to say, hey, this doesn't look good. We'd like to say no to this deal and move on. Another thing that you should focus on is the terms of the deal. You know, if you're going to pitch an angel group and you're saying, "Hey, this company is worth $5 million," make sure that when you go to the next angel group, you're sticking to the same valuation, right? If you're going to offer a board seat to one angel group, you need to offer that board seat to the next angel group. Basically, you need to have a uniform term sheet that is very clear. Sometimes it's good to have a USA, a unanimous shareholder agreement, that a lawyer can help you draft up. And that way, your term sheet is clear. I'm going to elaborate more on that in the next slide. So, mastering negotiation with angels, they're going to really push on valuation. They're going to push to try to get as much equity as they can. And the reason for that is because they are the first money in. They're always going to try to squeeze you. They're going to try to light a fire under your bum. They're going to try to, find a way to get more bang for their buck. Something that can be done to avoid that is really try to find a lead investor before going to all the angel networks. The importance of that is that you might be able to structure a clear term sheet and then get a commitment, get that money in the bank, and then go back to angels and say, hey, we have a lead investor. These are the terms on the table. If you're interested in following, please do. These are the terms. What's important about that process is it maintains a positive negotiation environment. It allows you to go in there with a little bit more leverage, and it gives investors or angel investors an idea that, hey, this is not a nobody who has never spoke to anybody before. We can't just push them around. I'm going to pause again. I am seeing the chat box is lighting up. Does anyone have any questions?
Mike was giving a little further tip to Farnaz. Mike was saying that sometimes the golden keywords sound more golden when they first come from someone they know and trust. With angel investor networks, I've also sometimes seen a certain angel will be willing to be a champion for the startup. In that case, you give them the words and work with them.
Absolutely. Yeah, that happens. That happens a lot. And the benefit of that is that you're going into this room, and again, like Mike mentioned, you're more comfortable. The investor is walking you into the room and really doing the introduction for you. That happened to us in quite a few different rooms, and we did see a more positive outcome. As long as you're in good communication with that friendly investor, because sometimes they might get overly excited and set you up for failure if they think your product is already ready, and you show up to the meeting to do a demo, and the investors would really pushing your product and you're not ready to do the demo. That could cause trouble. So make sure that you're in alignment, and make sure that you're building a long-term relationship with these investors. Even if they don't cut you a check from the beginning, especially angel networks, they're interested in learning about your progress. These newsletters that I mentioned, important to have at least one member of each angel network on these newsletters. Why? Because at the end of every quarterly or monthly meeting that these angel networks have, they carve out a little bit of time for each member to bring up new companies or mention what companies that they have been tracking are up to. So you really want to leverage that. Take advantage of their expertise and take advantage of their networks. I found that LinkedIn can really be beneficial to that with that and create more opportunities. Really, even if you don't make it to pitch the angel network, just maintaining a relationship with one angel in each network can really go a long way. And when you set clear milestones and expectations, you're going to be able to build trust with these investors, and that's what takes you to that credibility point, which can then get you into the room to pitch these investors. Especially with angels, they want to see first, they want to know how you think. They want to have a good relationship with you, and they want to see that you're hitting your milestones. They want, even if it means that you're not ready to sell the company on time, as long as you're growing the pipeline, you're building the revenue streams, you're validating your business models. They're very excited about that. They want to be part of the journey. So this part of the presentation is the one I don't prefer to speak too much about. I'm not a lawyer, but what we're going to do is we're going to go over a couple of key terms here that you might see when you're building a term sheet. I'm not going to spend too much time on it just for the sake of time, and just a few things to highlight. Things that you should really mention. What valuation are you raising money at? How much money are you raising? What type of shares are you offering? Is there a dividend associated with these investments? Is there a liquidation preference? Who's getting paid if the company fails? Are the shareholders going to get their money back before the founders? And conversion rights. If the company does go to a later stage, like an IPO, what happens to these shares that the early investors invested in? For example, in this case, they would become common shares. Couple more key terms to look out for. Anti-dilution provisions. This means that if an investor comes in at a later stage, that the investor comes in at a seed stage and the investor comes in at a Series A stage, they can't come in at a lower valuation. That basically protects the investor from being diluted further. Are they going to get voting rights? Is there a board that the company has thought of? Are these investors having the option to be appointed as directors of that board? Sometimes there are also more complicated things like right of first refusal, which gives investors the chance to participate in a future round before new investors. There are other protective provisions and information rights that investors can also hold. We're not going to dive too deep into that because we don't have much time left, but you should definitely speak to a lawyer about these things, or you can reach out to me and we can talk more about them. So, in conclusion, why angel investing? Angel investors, they're usually plugged into local networks. They're pretty easy to get a hold of. Usually every angel network has a button to apply to on their website, which will take you to a platform like Gust, Dealum, or more recently, we're seeing another one called Allstage. It's good to have these applications filled in. Why? First of all, it's like grant writing for you. You're updating your company's business model. You're updating your ideas. You're really getting the opportunity to outline where your business stands. And if you find that there are multiple angel networks you want to apply to, they tend to all use the same platforms. So you might be able to apply to them much more easily if you have these applications already set up. Last but not least, trust and credibility. Those are really things that are going to make you stand out. And if you find that you're not able to find any investors in your immediate network, try to reach out to some of your team members, your advisors, the incubators that you were associated with, or of course, LinkedIn. I can't stress on how valuable LinkedIn has been over the years. I've put up some books here that might be beneficial to read. And I also want to highlight a couple of angel networks that are here in Ontario. Again, Golden Triangle Angel Network, York Angels, Maple Leaf Angels, Halo Health. More recently, I've seen Durham Angels, Niagara Angels. As you can see, a lot of them are based on their location. And they really like to make investments in their jurisdiction or not too far away from where they live. So what we're going to do now is, I know that we only have around 10 minutes left. I just wanted to highlight that Steadiwear it took us around 1 million, it took us around 30 meetings to raise $1 million in 2021. Today, it took us around 75 meetings to raise that same amount of money. So economic environments can change. Things can really make a difference. And if you're trying to raise money, try to have everything ready as early as possible. Try to be reaching out to angels as early as possible. Because if you're going to them with just 2 or 3 months left of runway and not the right documentation in place, you're probably not going to be able to close a deal in time. These deals, they typically take around 2 to 3 months to close. So try to set yourself up for success. Constantly be on the hunt for, shred tax credit grants, shred tax credits or grants, competitions that can extend your runway. And at this point, I'll just end the presentation and open the floor to any questions.
Thanks very much, Emile. I posted that in the chat as well, that folks are welcome to post their questions there. If you'd like to ask a question or make a comment verbally, you can also raise your hand. And there is the Q&A box as well. Many ways to communicate with us. And Mike is here. Sorry, Mike. Glad you turned on your camera.
I'll just make one comment, actually, Alison, while we're maybe thinking of questions that, I know maybe there are some startups or entrepreneurs in the audience. I just want to kind of give my own, on behalf of, working with entrepreneurs and startups, thanks to Emile, because, Emile obviously has a lot of experience, success, but also obviously hard lessons learned. And, he doesn't have to take his time to do things like this, but I think it's a good testament to how entrepreneurs like Emile support the ecosystem and each other, and so it's only through this kind of engagement and communicating with each other and that we can really all benefit and benefit as startups. So I know a lot of startups and entrepreneurs would appreciate this kind of presentation from Emile. So I want to say thanks for that, but also for those here, hopefully, we can engage with you and with each other to learn.
I really appreciate it, Michael. And over the years, what I've found is that really founders will be the most helpful to other founders. Investors will might have a hidden agenda or have some different priorities. Founders, they they can relate to each other. They can help push each other forward, and they will be the biggest asset to you while you're growing your company, aside from AgeWell, of course.
We've had a few comments of thanks already, so I'm sure maybe people are, squirreling away their questions as they kind of mull over what they want to do or what their approach might be as they take things in. Perhaps more questions will come. Also for our attendees, I did post a couple of links in the chat as Emile was presenting of previous YouTube sessions that we held to support startups. One of them was on the legal sort of jargon and requirements for startup funding. So that posting is there from some legal experts, as well as I think there was one on the IP strategy for startups as well. So also important to look over those as well as the other videos. We do have a small series on the YouTube page on our startup resources. And you're always welcome to reach out to us. Well, it looks like there aren't any questions. Lots of thanks and appreciation for this webinar. So I guess I'll wrap it up. I really appreciate, as Mike said, I really appreciate you taking the time, Emile, to share with the community. And it's really important that we have folks like you who have gone through a lot of the process and are willing to share their experiences. So thank you so much.
No worries. It's my pleasure. I also put my email in the chat. I put my LinkedIn somewhere in here too. But feel free to connect, whichever way is most easiest for you. And thanks again for having me.
Thank you so much. And to all our participants as well. I look forward to seeing you at the next AgeWell webinar. And we will share the link on the YouTube page for the recording with everyone. So if you missed anything, you'll be able to see it there.
All right.
Thanks, everyone.
Thank you.
Bye.
Bye-bye.